March 2020 marked the lowest point for auto production since World War II. The U.S. International Trade Commission reports production levels dropped to what we last saw in 1945. For weeks, drone footage revealed factory lots eerily empty, where thousands of vehicles should have been rolling off assembly lines. At least 93% of U.S. auto manufacturing ground to a halt during those early pandemic months. Plants began reopening by late April 2020, but production didn't recover overnight. According to the USIC, it wasn't until July that output returned to 2019 levels. The Bureau of Transportation data paints a stark picture. The U.S. produced over 2 million fewer vehicles in 2020 compared to the previous year. Domestic car sales mirrored this decline, underscoring the scale of the disruption. The initial shutdowns triggered a supply shock, akin to a sudden earthquake shaking the foundation of the industry. But the real challenge came when demand surged unexpectedly. Stimulus checks hit bank accounts while people were stuck at home, rethinking their transportation needs. Many opted to spend that money on cars, especially as public transportation felt increasingly risky. Meanwhile, semiconductor manufacturers pivoted to meet skyrocketing demand for electronics like laptops and gaming consoles, driven by the remote work and entertainment boom. This shift in focus created a bottleneck for automakers. Modern vehicles depend on semiconductors for everything from engine management to touchscreens, and the shortage quickly became a choke point. Trade restrictions with Chinese tech firms like Huawei added another layer of complexity. Some companies began hoarding chips, bracing for future shortages. The result was a perfect storm. Low supply colliding with high demand, leaving automakers scrambling to adapt. By 2021, production numbers inched upward but never fully rebounded. Sales remained sluggish, as Ward's intelligence data shows. The OECD raised alarms about the fragility of global supply chains, warning that the pandemic's ripple effects were far from over. What began as temporary factory closures evolved into long-term production constraints, reshaping the industry's trajectory. Dealer lots, once brimming with options, became barren landscapes in 2021. Customers faced months-long waitlists for popular models, with delivery times stretching to unprecedented lengths. Manufacturers, constrained by limited production capacity, prioritized high-margin vehicles, leaving fewer affordable options on the market. The scarcity sparked fierce competition for available vehicles. Auction prices for used cars soared as rental companies and dealers scrambled to replenish their inventories. Wholesale used vehicle prices jumped 37% from 2019 to 2021, according to Manheim data. This surge rippled directly into retail prices, forcing consumers to pay significantly more. At the worst points, new car inventory levels dropped to under 30 days supply, less than half the traditional 60 to 70-day benchmark. This scarcity gave dealers unprecedented pricing power. MSRPs, once a ceiling, became a starting point. Customers often paid premiums just to secure any vehicle, let alone their preferred model or trim. The production gaps left a lasting mark on the industry. The USIC report highlights how the 2 million vehicle deficit created a hole automakers are still struggling to fill. Those missing cars represent billions in lost revenue and untapped consumer demand, a reminder of how deeply the pandemic reshaped the automotive landscape.